Welcome to my channel. I'm going to show you step-by-step how to value a stock to determine if it is a buy or a sell. We're also going to look at the financial ratios of the company, leave a comment, and I'll be sure to answer. We're going to look at Teladoc Health. It uses telephone and video conferencing software as well as mobile apps to provide on-demand remote medical care. It's the first and largest telemedicine company in the US. Launched in 2002, it acquired BetterHelp in 2015, Best Doctors in 2017, and Advanced Medical in 2018. It trades on the New York Stock Exchange and is active in 130 countries and has 27 million members. Let's get started with the model. This company has a market cap of $17 billion, so that's the value of the company according to the stock market. So it's a large cap company since it's over 10 billion market cap. And they're trading at $210.88, so that's one share of stock. And the way you value a company is you estimate the future free cash flows and then discount that back to today's dollars. That's what we're doing in this video. Now I just pulled in the actual free cash flow. Free cash flow is cash flow from operations minus capital expenditures. Now I'm going to pull in the net income, which is the profit and loss according to the income statement. And let's pull in the revenue, which are the sales for each year. Let's look at the numbers. So they're obviously investing a lot in their business to grow it because they have negative free cash flow most years and negative net income every year. But you can see their revenue is growing quite a bit each year. So it's in a hyper growth mode. It's going to be hard to value this stock. But let's move on with the model. Let's look at a capital structure. They pay $29 million of interest on their debt. Let's see how much debt they have. We go to the balance sheet for that. We go to the liabilities section. $440 million of long-term debt. They don't have any short-term debt. The interest rate on the debt is 6.6%. Let's get the cost of equity. We need the beta. That's how volatile the stock is relative to the market. 0.52 beta. 0.52 means the stock moves half what the market moves. So it's not volatile at all. Let's get the current assets because we need to calculate the current ratio later. That's $588 million. And that's $517 million of cash, $56 million of net receivables. That's how much money other companies owe them. And we also need the current liabilities. That's $90 million. We need these to calculate the current ratio later. And that's $9 million of accounts payable. That's how much this company owes other companies. $2.8 million of taxes payable. That's how much they owe the government in taxes. $18 million of accrued liabilities. These are expenses that have been incurred but have yet to be paid. $12.5 million of deferred revenue. When you collect payment for a product or service, but you haven't delivered it yet, you book that into deferred revenue as a liability, and then when you actually deliver the product or service, you take it out of deferred revenue and onto revenue on the income statement. $8 million of other current liabilities. Equity is $1 billion. That's the value of the company according to the balance sheet. 73,000 of common stock, negative 500 million of retained earnings, so they're operating at a loss historically. Negative 17 million of accumulated other comprehensive income. Let's go back to the income statement, get their operating income. That's negative 74 million. Let's look at a capital structure. They have 30% debt, and the cost of debt is 6.6%, 70% equity. Cost of equity is 6.3%, and the WACC is 6.4%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows, that's up here in blue. We also estimated a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $6 billion. We divide that by 82 million shares, and we get a calculated stock price of $73. It's trading at $211, so it's trading at a 188% premium. So it's a strong sell according to the model. Let's see what Simply Wall Street says. They're at 156, so they're also saying the stock is overvalued. This is also the type of stock that's going to trade way outside of its intrinsic value because people are looking to the future of the company and not so much of what the company has produced already. Let's look at the financial ratios to get more information. Negative PE, bad price to sales, bad price to book. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 31. Investors are paying $31 for $1 of revenue. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 17, so investors are paying $17 for $1 book value. They have a really high current ratio, a bad interest coverage ratio, and a bad ROE. Current ratio is current assets over current liabilities, so they have lots of current assets, probably more than they need. I like to see between 1 and 2, they're at 6.5. ROE is net income over equity. They have negative net income, so they have negative ROE. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. And I don't have any companies to compare them to because this is the only company in the health information services industry. And the model I used to calculate the stock price was my alternative model, which I built for Tesla. The way this works is I forecasted future free cash flow based off of the growth in net cash flows from 2016 and 2019. Because if I use my regular model, the value came out negative because they're only reporting pretty much negative numbers. So let me know what you think of the video. Leave a comment, I'll be sure to answer. Thanks for watching.